Very good morning to everyone. I welcome you all for today's session on actuarial valuation. Yes, this is going to be an offbeat topic, but as a valuers, we are expected to know many things. So let us today explore the world of actuarial valuation. It's an immense privilege to introduce today's speaker, Mr. Naveen Iyer. He's an experienced actuary come chartered accountant. He has close to 2 decades experience in financial services. He's also a qualified cost and management accountant and he's a gold medalist. He has qualified as a fellow of the Institute of Actuaries of India and holds the relevant certificate of practice to provide actuarial consulting services. Prime Actuarial Solutions is an independent actuarial consulting firm operating in the field of insurance, employee benefits, and risk consulting. It has been providing services to reputed multinational companies and Indian companies since the past 2 years of its inception in both areas. Prior to starting his actuarial firm, Naveen has worked in various capacities at subsidiaries, joint venture companies of multinational insurance companies in India. Mr. Naveen, I know how difficult it is to clear the actuarial examination. I'm immensely delighted to know that, a fellow professional has cleared all of this, such a tough. I understand there is no colleges, no specific syllabus, and it's extremely difficult to clear the exam. Can you throw some light on this and then proceed for the session?
Oh, yes. Yes. Thank you so much, ma'am. Thank you so much. Very kind of you to have given such a warm sort of introduction and welcome everybody for today's session. Obviously, it is a bit heavy duty. I'll try and make it as simple as possible. Yes, who's this? Someone's raised their hand. Has somebody raised their hand?
No.
Okay, sorry, I probably am mistaken. Yeah. Again, so it's a bit heavy duty. We'll try and make it as relevant as possible. Obviously, I'll cover some details around the gratuity valuation, which is I'll take that as an example for the employee benefits, which happens for every company, which follows the sort of Ind AS or AS guideline. Before we jump into the topic per se, like ma'am was asking, what is the sort of syllabus or what is the sort of process for qualification as an actuary? The one thing is I qualified way back. I qualified in 2008, where the syllabus and structure was quite different from what it is now. But the backbone is the same. It's about, when I passed, it's about, we had 15 papers, 15 papers we had to pass in different phases. Now it's probably lesser. But the structure is very much the same. And in terms of coaching, in terms of guidance and support, it has increased over time. So in the past, yes, you're right. There was hardly any coaching, but now we do have quite a lot of maybe actuaries or even qualified actuaries who do run their coaching centers, including online coaching centers, thanks to COVID and thanks to the adoption of online education, given all the massive education startups in this country. We do have decent coaching options, I would say, at least for the junior level. So there are basically 4 parts to the examination. The first part is, highly technical in nature. It used to be 9 papers. Now I presume it's 6 papers. The second part is about, again, a combination of written, sort of practical Excel-based skills and sort of theoretical knowledge. The first 6 exams are pretty much theoretical. It's like you got to study the study material and obviously questions are asked. The second part is a bit Excel-based tests also, where some practical problems are also evaluated. The candidate has to, in the examination condition, create a model. Given a problem, create an Excel-based model, or, there could be another, I think they've introduced, when I was qualifying, it was at Microsoft Excel. Now it is one of the programming languages, I think, called R. So they're being tested on that, where you create a model on that language. And then the number of hours given is more. Obviously, it couldn't be a standard 3-hour exam because you're creating a model. It's longer. It used to be 8 hours, when I, qualified way back. Now also, I presume I do not find the details. The students in my team are closer to these details who write these exams, my employees. But nevertheless, that's there. And then there is the next. So like I said, the first phase is quite theoretical, typical 3-hour exams, study the study material, ask questions. Second phase is a bit practical plus theoretical. There are combinations. The third phase, again, is more sort of higher order thinking, higher order testing, higher order skills, which is becomes relevant to certain practice areas. So we have from the third stage, life insurance, general insurance, employee benefits becomes a little focused on the practice areas. And the final phase is the fellowship exam. Again, it's relevant to the practice areas, which is life or general or pension or investments. So I'm a life actuary. I qualified as a life actuary. Obviously, fundamentally, there are a lot of interconnection within these practice areas also. It's like direct taxation, indirect taxation, like we have accounting costs. We don't really have a specialization paper per se. We have a fellowship exam in our CA, CWA. At least what I remember, I qualified in 2003. So, even way back. But the main point is in an actuarial setup, there is a lot of interlinkages, especially between life insurance and employee benefits. The one we are going to talk today is the one employee benefits. And general insurance, again, it's got its own dynamics. Interesting course, I would say. If people who want to explore this further, they can surely write to me or WhatsApp me. I'm going to share my credentials at the end of the session. Anyways, my mobile number and my email ID. More than happy to guide anybody who's a little curious. Yeah. So, ma'am, is there anything else you want to specifically know before we jump into the topic on the qualification process?
That's all. Many young enthusiastic, youngsters are trying to take this.
Yeah,
So
yeah,
one
yeah.
of my,
It is. It is. It is.
What is
Yeah.
the
It's.
eligibility criteria, sir? For
What is the?
educational qualification eligibility?
It has changed, but they used to, look, when I used to write the exams, it was, you need to have some maths background, and even 12th standard maths exam cutoff, they used to take 85 marks. If you have more in 12th standard, you can enter. Now, in India, there is a entrance test. There is an entrance test. You got to pass that. Then you can start writing in India. And
Okay.
I qualified from the UK. Then I took an exemption in India. In the UK, again, it's your grades, your 10th, 12th grades, or if you're a, your college degree, they'll consider that and give you the admission. You're going to give the document. But I'll find out exactly. Like I said, it's been such a long time, but I will find out. Anyone's
I am
further
asking whether CA, CMS can be
Yeah, I'm
eligible.
sure. I'm sure. Look, it was so funny. I'm just a small anecdote before we jump into the topic. When I qualified, I didn't know it was there was an exemption paper for CA, CWA. I could have avoided one exam, by the way. I didn't know that also. Like they say, you get an exemption. One of the papers, you'll get exemption in the third phase, even today, because you're a CA, CMA, that's applicable to you. But funnily, yeah, I wrote all the exams. I didn't know. But anyway, so these things happen.
Okay, thank you.
More than happy to guide you, yeah, if there's any questions. So lovely, ma'am. Thank you so much for the kind intro and, so let's jump into the topic, guys. Obviously, I'll try and make this as, as simple or as contextual as possible. Obviously, it's heavy duty topic anyways. So how many people have encountered actuarial valuation in their, normal course of work? Have you, what I'm just trying to understand very broadly, right? If few people can say, what do you understand about this exercise for employee benefits? We're talking about gratuity valuation or leave valuation. Have people?
When I was in corporate, in
Mhm.
the financial statements, we needed this,
That's right.
provision for gratuity and leave encashment. We had approached actuary.
Right.
So we had to give lot of employee-related information,
That is true.
especially the age, the actual pay as of now, when
Right.
did they join and all of that stuff. And
Right.
on that basis, the actuary provided us the provision.
Right. That's right.
Provision
That's
for
perfectly
gratuity,
right.
provision for leave encashment.
That's perfectly right. So yeah, that's right. So the idea, obviously we're going to talk about it further, but the basic thing is actuarial valuation. This is guided by accounting standards. So here in India, the two accounting standards that we rely on is the Ind AS 19 and AS 15. Obviously, as you call them, IGAP and IFRS equivalent. Ind AS is IFRS equivalent. So basically, the idea is there is some criteria based on which we have to conduct this valuation, and those criteria is what I'm going to first cover. Let me just share my screen so it'll be easier. When I talk, it'll be easier for people to put a context. I will share this presentation at the end of the session. Yeah. So I'm just sharing my screen. Can people just a second, please? Just 1 second. Am I audible? Is it clear? For everybody in the
Yes.
Very clear.
yeah. Good.
Yes.
I just want to ensure that. Yeah, 1 second. Just a second. One. Just 1 second, guys. Yeah. Can people see the presentation? Can everybody see it?
Yes.
Yeah. Can people see my screen? Great, great, great. So the first thing I'd like to cover is the applicability of Ind AS. Are people aware of the applicability rules? I mean, when is AS 15 applicable and when is Ind AS 19 applicable? Are we aware or should I? So I'll just quickly cover about this first. So the Payment of Gratuities Act talks about a 10-member limit, right? If your employee headcount exceeds 10 employees, the Payment of Gratuities Act becomes applicable. And under the Payment of Gratuities Act, are people aware of the vesting criteria and the sort of amount criteria in terms of what's the maximum benefit cap proposed?
I think you can slightly touch base and then proceed.
Yeah. So it is 5-year vesting, right? So under Payment of Gratuities Act, if you look at the rules and if you look at the provisions covered under the Payment of Gratuities Act, it simply says that there is a vesting period of 5 years for employees to receive a benefit due to the gratuity, provision, to receive gratuity benefits. However, what does 5-year vesting mean? It means the employee should have at least rendered continuous service of 5 years before he becomes eligible for a gratuity payout. But this 5-year vesting is not applicable for death and disability. Yeah, you got to note this. Most people say 5-year vesting is there. That's right, but that is only for resignations and retirements. It is not relevant for deaths and disabilities. Just a small point. And the other point is there is a 20 lakh benefit capping. This has been, in fact, they keep getting increased. Now there is a lot of maybe talk that this is also going to further go up. 31st March 2018, this limit was increased to 20 lakhs. Until 31st March 2018, it was 10 lakhs. On March 2018 or March 2017, I don't remember the exact date now, but sometime in the recent past, 6-7 years back, they increased the limit from 10 lakhs to 20 lakhs. Okay, this is the applicability, and Payment of Gratuities Act becomes mandatory for 10 employees or more. Now, AS 15 is applicable based on whether you're a medium, as we said, SMC and non-SMCs, right? So they have this whole criteria under the accounting standard, sort of classification. There are these rules that differentiate between what we call not small and medium company and small and medium company, SMC and non-SMC. So if you have more than 10 employees, then I think actuarial valuation is mandatory, right? So that's the rule. And then what tends to happen between SMC and non-SMC is really a disclosure issue. If you have what we call a non-SMC company, then full disclosure becomes mandatory. And again, there is a slight distinction between what we call under the accounting standard, the post-employment benefits and other long-term benefits. So as an example, gratuity is a post-employment benefit. Pension is a post-employment benefit. So when it comes to post-employment benefits, you definitely need, to provide full disclosures for a non-small and medium enterprise, non-SMC. But if it's another long-term benefit, for example, leave is another long-term benefit. It is not mandatory that you need to give all the full disclosures, current service cost, interest cost, certain other things that we evaluate for post-employment. It is not mandatory. And this is a bit of a, I would say, misunderstanding in the market. Normally, people don't know this. They feel, irrespective of whether it's, they don't probably know the distinction between a post-employment and another long-term benefit. Sometimes we do get questions saying, no, even if it's another long-term benefit, like long-term incentive plan, that's a classic case. I'll be covering all of that also in terms of typical benefits that we value. So sometimes we've seen even auditors or even maybe other CFOs or accounts professionals ask for the full disclosures for other long-term benefit report. While theoretically it is possible to produce this disclosures, practically it doesn't serve any purpose, and the accounting standard does not require you to produce those disclosures. So the limited point I want to make is between a small and medium SMC company, small and medium company, and a non-small and medium company, The non-small and medium company needs to give full disclosures. A small and medium company need not give full disclosures, irrespective of whether it's a post-employment benefit or a other long-term benefit. So that's the first point. The second point is, even for a not small and medium company, non-SMC, there is a criteria that I've put on the slide here. For non-SMC also, it is really only for post-employment benefits like gratuity, pensions, etc., where full disclosure is mandatory. In other long-term benefits like leave, long-term incentive plans, even a non-SMC company is exempt from full disclosures in terms of interest cost, service cost, and other things that we'll talk. So here you can see what is a non-SMC. It's basically an equity. There are these criteria of turnover greater than 50 crore, borrowing greater than 50 crores, turnover greater than 250 crores. A financial institution, a bank, or equity or debt securities are listed or in the process of being listed. Yeah. So that's a non-SMC. Then there is this thing on Ind AS. Ind AS applicability is pretty much clear nowadays, but this had launched. I mean, I'm sure a lot of professionals here will have a better idea than me. I'm only giving it in the context from Ind AS 19. But April 16, it was for all companies more than 500 crores. I think from April 17, it applied to all listed companies. So all listed companies, whatever your criteria is, it doesn't matter. Ind AS is applicable. But unlisted companies more than 250 crores net worth also became applicable. For NBFCs today, it is applicable. So that is there for NBFCs more than 250 crore. It becomes applicable for NBFCs, whether listed or unlisted. However, for banks and insurance companies, this is the original plan, man, and everybody in the call. But I don't think the IRDA has rolled it out per se. I mean, it's not a firm applicability because I am from the insurance industry. I work with a lot of insurance players. They only ask for pro forma disclosures. It's not fully made applicable yet. And for banks also, I presume it's the same case. It's not fully rolled out as such. But this was the original plan for Ind AS. Yeah. So the idea being when it's applicable, just to give a background. So that was on the applicability of Ind AS. One small thing I'd like to add is, very often we hear that we have gone to LIC and LIC has given us a so-called disclosure statement or the actuarial valuation statements, and we are adopting that for our accounting. See, that is not correct. The reason that is not correct is in LIC report, and when they also have software that produces actuarial valuation and actuarial disclosures. Unfortunately, it is not signed off by some professional actuary within LIC. It's not a professionally certified report, first. Second, LIC also doesn't hold any accountability. So if you go to an external professional actuary like myself or any other person, okay, there are many colleagues of mine who are doing a good job in this field. We actually certify the provision. We actually give a disclosure. We give a lot of conditions and we sign off. We are professionally accountable for the number we give. But in an LIC report, there is no name, there is no membership number, there is nothing. So there is a real accountability issue first. Second, as per accounting standard, it's supposed to be done by a professional valuer. It's not by some software. So my humble advice and my request to all the members in the call also, if you get a chance, if you are in a position to influence, you must definitely put forth to the relevant management that an LIC actuarial valuation, which is just a software giving numbers, is not a proper AS 15 or Ind AS 19 report. Yes, numbers can come, but it's about accountability. And it's also about the way the assumptions are set. In an LIC report, they don't set specific assumptions relevant for the organization, which an external professional actuary, such as myself or any other colleague, will set, because that is what the accounting standard requires. Assumptions that we set in context, looking at the turnover of the past, employee turnover ratio is set. Looking at the salary escalation of the past, salary escalation assumption is set. Looking at the average duration of the liability, the discount rate assumption is set. All this is not done by LIC software. It's broad brush. So just a very small thing. But have you people come across an LIC valuation? I mean, just to throw it open to the team. Has anybody really come across an LIC sort of a valuation report where where your clients have said no, we don't need external actuarial value. We will do through LIC, and that's what they use. Have people come across that, ma'am? I mean, anybody in the call? No.
No.
No. Okay, no problem. But just keep it in mind. I mean, just a small piece of advice, especially when we talk to auditors. Very often we hear this from their auditors that the client is saying LIC is giving this, but That's not a professionally certified actuarial opinion because assumptions are not set in context, which is required, and there's no accountability. There's no professional signing off the number. Anyways, so these are the typical benefits being valued by actuaries, okay, in India. So you have post-employment benefits, which is pensions, gratuity, exempt provident fund, and post-retirement medical benefits. So on exempt PF, what we value is very interesting. So typically we get involved in defined benefits, which is any benefit that is formula driven for the employees. Exempt, and we don't typically get, involved in India for defined contribution schemes where each employee contributes a small amount every month from their salary and the corpus builds up and the accumulated corpus is used, either, in some form or fashion, either they annuitized at the relevant annuity rates in the future or it's withdrawn. In DC schemes, actuarial valuation becomes mandatory only when there is any floor requirement or a defined benefit underpin. Example, in Provident Fund, if I take an exemption from the relevant government authorities and I have my own trust and I have what we call exemption from contributing to the government Provident Fund scheme, the expectation is the exemption is given by the government authorities to the organization to run an exempt PF scheme only provided the benefits given by the employer under its exempt Provident Fund scheme is better than what is provided by the government under the PF scheme, which means at a minimum, the interest rate which is credited every year by the trust of the employer running the exempt PF scheme should be greater than or equal to the interest which is credited by the government. So that is why exempt Provident Fund comes under the domain of actuarial valuation because there is a defined benefit underpin. So just a small example there, nothing more. So pensions, gratuity, these are post-employment benefits. Where I was telling you a couple of slides back, you need full disclosure in this for a non-SMC company. But, you don't need full disclosure under AS 15 or Ind AS for other long-term benefits, which is privilege leave, sick leave, incentives, bonus, blah, blah, blah. Just a small example there. Then you don't need actuarial valuation for short-term employee benefits, right? Because we are concerned with long-term benefits only. So anything which is payable within 12 months from the balance sheet date, short-term bonuses, or if a leave lapses within 12 months, you don't need it. Again, just a small highlight in terms of where actuaries get involved. We get involved typically when the benefits are long-term in nature, where it's payable on resignation, death, retirement, etc. And it's payable not just within 12 months on the balance sheet. If it's beyond 12 months from the balance sheet date, that is when actuarial valuation becomes mandatory. Yeah. Any questions, comments so far? Can I proceed?
Sir, one question here. So if the leaves can be carried forward after an year, but it cannot be encashed, does that need to be valued?
Excellent question. Thank you so much for raising this question. The valuation is not dependent upon encashability criteria. The valuation is dependent upon whether there is any utilization benefit, either via encashment or via taking leave beyond 12 months. For example, if I have a leave policy, let's take sick leave. Usually sick leave is not encashable, usually. So let us say beyond 12 months from the balance sheet date, you can carry forward the sick leave and utilize it. You can go on leave for sickness. In that case, if from a reading of the accounting standards and the guidance notes, etc., you need to value sick leave benefit for that company through actuarial methods because it's long-term compensated absences. It is a long-term compensated absence. Beyond 12 months also, the person can carry forward the leave and utilize it. Utilization need not mean encashment. Utilization can simply mean going on leave, taking a holiday, fully paid leave. That's also utilization. Okay. So it's a good question you asked. Thank you so much for the help of all the members. So the criteria is not encashability. Criteria is usability. And if beyond 12 months, I can carry forward my leave and utilize it for just taking leave, right? Fully paid leave, if I utilize it on that basis, not encashability, yes, we call it leave
And-
availment. So every leave valuation consists of two parts. One is leave encashment, which is what most of us are familiar with. The other part is leave availment, going on leave and you're basically getting compensation fully for that. Yeah, that's what it is. I hope the question is answered and
Yes,
thank you
sir,
so much.
yes, sir.
And guys, please make it interactive because it really helps me also. Obviously, the more you ask, the practical experience is probably more important. The slides are there, sure. We try and cover as much and trying to depending on the audience, we try and keep it at a fairly high level because obviously there's so much to talk about every topic. But the more questions you ask contextually, it's easier for us. It'll make it more interactive. Yeah, thank you so much, sir, for raising that question.
Sir, so thank you for asking. Just for broad understanding, I want to ask, see, the new labor code might come out soon. So is there any, conceptual or, difference relating to gratuity
Oh,
and,
yes, sir. Yes, sir. It's there. I'll try to I'll try to touch upon it. The wage code, as we call the social security code. See, it was there earlier also, in the sense the president of India had given assent, if I'm not
yes,
wrong,
yes.
in
But it's not
30th September.
ratified by many
Yeah,
states.
yeah.
Yeah.
If I'm not wrong, 30th September 2020, if my memory serves me right, 30th September 2020 it got signed off as a law. But yes, states have not ratified it, you're right. There is something to do with what we call part-time employees, short-term employees, contractors, the vesting criteria for media companies has become 3 years. I'll try and touch upon it. So yes, there are differences. There are differences and funding has potentially become mandatory. Now, already in Karnataka, thanks for raising this point because it is a relevant, it's a related point to cover. So there is this thing that after Social Security Code, that SSC comes into applicability, funding against gratuity benefits, right? A post-employment benefit, to be precise, is going to become mandatory. Which means you need to have a trust or, even if you don't have a trust, you have to fund it. The idea being that an unfunded provision is not going to give any big security for the employees. If it's funded, then yes, there is some meaning to it. You're holding a provision for gratuity benefit, but you're having a fund against it. Typically, what people do is invest in an insurance policy, typically. So that's the most common way of funding these benefits. You can do self-investment as well, but normally people invest in an insurance company because that is their expertise. So, sir, what happens is, now in Karnataka, this has become mandatory. Are we aware? Even in Telangana, it is mandatory. Are people aware that in Karnataka now funding for these gratuity benefits has become mandatory? Are people aware in this group that it's become mandatory now?
No.
Hello? Okay. So there was a circular released by the Karnataka government. It's not about social security code. It's just independent. But one of the implications of SSC is that whenever the state adopts, that's going to become there. So I think things are converging. That's my point. But just to touch upon a question which was asked, or a relevant question, let me just take the opportunity to talk about material changes that's going to happen. Sir, if social, so good name of the person who raised this question on SSC. What's your good name, sir?
Yes, sir. It's question on SEC only. My name is Munish Agarwal.
Hi, Munish, sir. Good. So Munish's question on SSC, effectively what's going to happen, which is a very important change, is presently gratuity benefits are valued with a particular definition of the gratuity salary. The gratuity salary definition, as per the Payment of Gratuities Act, is basic plus DA, basic salary plus dinner's allowance. Now, under the Social Security Code also, there is a particular definition for this gratuity salary. But that definition has caused quite a stir. It's saying at a minimum, it should be 50% of gross pay. Minimum gratuity salary will become 50% of your cost to company or gross pay. There is also a slight debate whether, there are so many nuances there, but I'm trying to, give a high level, like an 80-20 rule. I'm trying to talk about the critical aspect that is being covered by that. So what is going to happen once SSC becomes mandatory? Many employers will have to restructure the salary benefits of their employees because gratuity benefits, whatever benefits they're going to get on death, resignation, retirement due to gratuity, the basis for that, the calculation methodology, right, which takes gratuity salary multiplied by 15 by 26 into the number of, completed years of service. That gratuity salary is now going to be at least 50% of the cost to company or gross wages. There's a minor debate there, but, just for our purpose, let's say C2C. So then what's going to happen, sir? There'll be a noticeable jump in the liability, one-off jump in the liability. And this is a cause of concern for many corporates, particularly listed companies. I am, aware of several companies who have already adjusted their salary structures. They're trying to bring it already. I mean, when this was announced in September 2020 itself, right? I mean, we've been debating this. So that is definitely going to happen. That's a very important jump. The other things are, so this is like a material hit because, typically the basic salary is between 30, 35, 40% of the cost to company in most, in most corporates. So now something which was, say, on average 30, 35% of the gross pay, and now it becomes 50%. Now that's really a good 20, 25% jump. And that's a proportional hit on your balance sheet because the provision is going to jump. The provision for gratuity will jump. So that's a very material impact, sir. The other point is for certain segments, a certain classes of industry like media, the vesting period has been reduced from 5 years to 3 years. That's change. So those companies like media companies, you will see that liability again will be impacted. It'll become onerous, right? There'll be an increase. And the other bit I told you, sir, the third thing was like contract employees. Earlier, a contract employee was not covered by the Payment of Gratuities Act. Now, under Social Security Code, even contract employees will be covered. Yeah, they'll be covered. On a proportional basis, you'll have to do their actual valuation, gratuity, whatever, give those benefits. And fourth, I was just talking about funding. I was mentioning that, again, there's an interpretation difference amongst our practitioners also. But yes, there is one way to look at the whole thing is the liability, which is the gratuity benefit or whatever, cannot be unfunded. Yeah, you got to fund it. More and the most I would say famous or the most common method is via insurance policy. Get an insurance policy because they are experts in managing it. So typically, insurance funding, what happens is the insurance company will manage the money on your behalf, invested in the markets. I mean, you can choose a unit-linked, market-linked plan, or you can choose a non-market-linked plan. They will manage the money for you. And whenever there is an employee resignation, retirement, death, or employee payout, you can claim it from the insurance company. The insurance company pay it to you. You can pay it to the employees. Yeah. So that's what's a very common way to manage it. Any other
Thank you,
questions
sir.
before we can deep dive into the sort of nuts and bolts of the valuation? Yeah. Can I proceed? Okay.
Yes, sir.
So so this is the employee census data we normally need. Yeah. I'm sure Shilpa ma'am was just telling, she was just mentioning that, they fill these big formats. That's true. So the first thing that we need is a census data. The census data consists of employee code. We don't need the name really, the employee code, because we need a unique identifier to do comparisons. Employee code, the date of birth, date of joining, the salary, so salary will depend upon the benefit. Like gratuity could be gratuity salary. As an example, today it is basic plus journal's allowance. Tomorrow it will still be basic plus journal's allowance, but subject to a minimum benefit of 50% of cost to company. So that's where the change. We also take the CTC because when we do leave valuation, we need cost to company also, especially availment valuation, because we value the cost of taking leave. When employees go on leave, the cost of that availment is measured using cost to company. It's not measured using encashment salary. If you encash the salary, a leave benefit, it depends. Each company has its own policy. So leave can be encashed at basic pay, gross pay, cost to company, anything. But when you avail leave, when you go on leave, that is measured via cost to company. There is an ICAI guidance on this, very old guidance, but it's there. It's logical also. You're an employee, you're working, your CTC is your overall cost for me, for employing you. You go on leave, that is the implied cost, notional cost of your leave. It is measured on the basis of cost accounting. Then we take the leave balance, leave movements, normal retirement age, etc. When it comes to the leave valuation. What I'm going to try and do, I'm going to try and quickly present our standard Excel data format. It'll probably add a little bit more, what you call, a little more context, so that, you know, when people tomorrow, when you maybe discuss this, or maybe when you are interacting with some other professional, or even, you know, your own companies, your own clients, it'll add a bit of context. I'm just going to download a file. Just give me 1 second only. So I'll just share this with you. Yeah.
Mr. Navin, you're trying to share anything with us?
Yeah. I'm doing that. Just 1 minute. Huh? 1 minute. Just sorry. Just 1 second. Just 1 second. I am just it's taking a little bit of time to download. 1 minute. Yeah, I am just opening my screen. Yeah. So sure, people can see my screen now. 1 sec. Where is the share button? Sorry, why is the button missing? 1 second. Yeah. So I've just opened our standard data. This is something my company gives, right? If somebody comes to me and asks for a valuation, we asked this standard information for gratuity and leave. I mean, obviously there are other benefits, but I'll focus only on gratuity and leave. So this is the census. Can everybody see my screen? Sorry, can everybody see my what I'm presenting?
Yes, sir.
Great. So standard information, right? We ask for employee. This is census data. There is other than that also. I'll talk about, I just thought it'll be more practical rather than going through a PowerPoint slide. I can just talk about the format directly. So we ask for employee ID. Obviously, name is not relevant. You don't have to give it to us, but we need employee IDs to do comparisons, right? Between last year, this year, we do a lot of movements. Then we'll take an employee name, department, date of birth, date of joining, the salary. I told you, gratuity salary, which is presently basic plus journals allowance. But I told you tomorrow there'll be a minimum floor of that. It should be at least 50% of cost to company. Anyways, leave salary again, as per leave policy, it could be gross salary. This is for encashment. The leave salary is for encashment. Cost to company, we need it for availment valuation. Like I told you, also value that. Somebody, like Manish sir just asked, you know, what about non-encashable leaves if they carry forward? I said, yeah, you have to value them. And we value them mainly, I mean, there could be privilege leave and other things where both are applicable. Encashability is also applicable. Availment is also applicable. So we take both into account when we do the valuation. We do both of that. Then we take the leave movement. Okay. This is extremely important. Although we are valuing the leave balance on March 31st, I'm just coloring it for everyone's benefit. Although this is the leave balance we are valuing, March 31st, 2024, we are valuing whatever leave balance is outstanding. That's what we do. But we also look at reconciliation. There are reasons, because to set some assumptions, we need this. We're looking at the leave movement for, generally we ask for 2 to 3 financial years normally. This is the current data. This is the 23-24 data. We also ask previous data, 22-23 for the leave, because we need to do certain assessments, something called a leave availment rate. There are methods called FIFO, LIFO, there are a lot of things, but we need data. Unless we get proper data, our work is not good. So it's like any valuation exercise, right? It's garbage in, garbage out. If the input data is garbage, the output is also garbage, unfortunately. So we insist that clients give us this as much as possible. They give us relevant data. This is just a leave movement from their system. What is the opening leave balance at the beginning of the financial year? And then we ask how many leaves got added during the financial year. That's this column. And then we ask how many leaves got availed during the financial year, how many people went on leave. And actually, we also ask how many leaves lapsed during the period where, there was a limitation of carry forward and the person did not encash it or avail it, it lapsed. And how many leaves got encashed during the financial year. And then, of course, the closing balance. So we look at this for setting certain assumptions, like I mentioned. So even for non-encashable leaves, so we, as you can see, we take it separately. If everybody can see my format, we also take for example, I told you sick leave. It's a non-encashable leave. Separately for that also, we take the entire movement, opening balance, what's the addition, what's the deletions, and the closing balance, and the cost to company, because it's valued at cost to company. Okay. We take this input for 2 years. We take it for current and previous, because we need to do a lot of comparisons, okay, to set assumptions. For instance, we look at the trend in the attrition, trend in the salary escalation before we set the assumptions. So I'll come to that in a minute. So we need to get proper data so that we can do the proper, our valuation exercise is more refined. We do a proper analysis and recommend the right thing to the client. So one of the most important assumptions in the typical gratuity or leave valuation is salary escalation rate and attrition rate. Salary escalation rate, of course, discount rate is also equally important, but that is not controlled by the client, actually. It's controlled by the market. And we as actuaries set it ourselves. I'll also talk about that a bit. On the assumptions piece, 3 critical assumptions: salary escalation, attrition, and discount rate. Of course, mortality rate is also there, but that is, human mortality is not very, very high. COVID, of course, was an exception. But even then, human mortality is not very high on a steady state basis. It's not something that is going to swing the valuation much, because most people, at least India, everyone's young, and the valuation as such is not that onerous. The mortality is not a very material assumption. Material assumptions are salary escalation and attrition, and of course, discount rate. Now, when I set the assumption, I look at past data trends, because we feel the past is a reasonable indication for the future. So one of the things that we have always bothered about is, as per accounting standard, the assumption for salary escalation for future and attrition for future should be long-term, steady state assumptions, long-term steady state. What we mean by that is, just because in the recent past, due to some external events or abnormal events, either specific to the company or specific to the market, if there are certain abnormalities that have happened, say in salary escalation rate or an attrition, that cannot be taken into account for setting the assumption for future. A classic example I can tell you, which is what we faced when COVID occurred in financial year 2021, 22, lots of companies didn't give salary escalation. They didn't give increment only. I don't know if you've seen it in your clients, but it happened. Many clients, they get very, very low increments, or they didn't give increment during COVID because their turnover was affected, business was affected. And sometimes in some industries, a lot of attrition happened. Voluntary. Just to give you a background or a clarification, the attrition assumption that the accounting standard talks about, that is used for valuation, which I said is long-term steady state, is not related to retrenchment or what we call involuntary attrition, when the employer sacks you or asks you to leave. That is not covered under the actuarial assumption. What is covered is only voluntary, typically. Why? If there's a very, very, very consistent trend, you can tell your actuary, and yes, he may want to make an adjustment for that in the assumptions, because here we're talking about long-term steady state. In steady state, we're not expecting any company to keep on regularly retrenching people. So historically, if there's been a retrenchment due to any event specific to the company or to the market, or abnormal, say, salary credits, like example, the company is doing extremely well, so they give 30% increment for 2 years, continuously. Or in COVID, company didn't give increment at all for 1-2 years. That cannot be taken as a benchmark for future assumptions. We got to adjust for that and set assumptions taking a normal sort of past history into account. So we got to analyze Typically, we analyze 3 to 4 years, okay? And then we talk to the management, HR, blah, 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 and then arrive at assumption. Or we use benchmark assumptions. We have our own, and we do, like, say, someone like me, like we have more than 1,000 clients we do valuation for. So easily we have some trends we know. So IT companies, manufacturing companies, hospitals, education companies. On average, what is the salary escalation and attrition? We tell the client, look, this is what broadly we tell for your industry. You let us know. You want to use this, you want to change it. In case the client does not have experience. So when it comes to salary escalation and attrition, especially because quite dependent on the company concerned. We look at past history, we look at trends, we compare all of that, present it to the management. If they don't have very, very good, reliable past trends due to lack of credible data or because they're new or whatever, or maybe recent experience was affected by abnormal events like COVID, etc. We obviously discuss with management and arrive at a suitable solution. But these are very, very critical assumptions. Like I said, salary escalation and attrition. And like I said, these are company specific, right? This is something I was mentioning some time back. Yes, there is an influence of the industry you belong to, no doubt. But you need to look at the company performance and you have to somewhere justify to the auditors. So the client owns the assumption. The client is the owner of the assumption as per accounting standard. So if they finally say, look, this is the assumption, the actuary has to accept that assumption for salary and attrition. However, the actuary has to test the reasonableness of the assumption, whether the assumption looks reasonable or not, and comment on the reasonableness of the assumptions. So this is the guidance given by our institute, the Actuarial Institute, to its members. We are expected to comment on reasonableness of the assumptions, whether they look reasonable or not. Because it cannot be that whatever the employer wants to reduce the liability, he'll give an assumption, the actuary accepts it. While the accounting standard very clearly states the employer or the sponsor is the owner of the assumption. However, the actuary will comment on reasonableness. The auditor is supposed to, of course, bless these assumptions. I mean, obviously, he also gets involved, right? So he's also supposed to evaluate and, be comfortable that, yeah, he's relying on an expert and the reliance, he's got some comfort around whatever assumptions are chosen by the management and commented upon by the actuary. So that's on the salary and attrition. So that's something we take, as you can see over here. So you can see this here that we actually take the assumptions for attrition rate, which could be age driven, past service driven. It could be a flat assumption. We also take the salary escalation rate assumption. So can people see my screen? Is it visible? Over here, I put it on green. These attrition rate and salary escalation rate.
Screen size.
You can see, right? Yeah.
Can you please increase the screen size?
Increase, is it? Okay, sorry. Yeah. Obviously, with an online meeting, these are very relevant, You have to can't lose the audience. If it's a face-to-face meeting, it's easier. You can look at the audience and understand what's happening. In an online meeting, sometimes you're continuously talking. You don't know what's whether it's contextual, is it going above the person's thing or not. So thank you so much for that feedback. So I've just marked it in green. Okay, so we take it. Yeah, we take input from the client. Obviously, we do our own checks and balances, but effectively, we look at the past history, right? That's what we do. Just 1 second, guys. So that's got salary escalation and attrition. Like I said, it's important and it should be contextual. And when I mentioned LIC doesn't set, they don't set it looking at the company's past history. Obviously, there's nobody there, right? It's just a software. You give it, they just give you one thing. And which is why it's highly, highly recommended that you choose a private professional, someone who's in practice, who's accountable to do the job. They will do all this properly. If you just go to LIC, yeah, they will just give you a number, unsigned certificate, but clients do it just to save cost, but that is not in compliance with the extant accounting standards. Anyways, the third assumption, which I want to talk about, is discount rate. So we're all valuers. So let me throw a question here. The value of any financial asset or financial liability as per IFRS or all the fair value standards, do we all agree that it is typically a present value of the expected cash flows from that asset or liability? So it's a question I'm asking.
Yes,
Yeah. We have an agreement there, right? Any financial asset or financial
Yes.
liability under IFRS, I mean, in any fair value standard you look at, be it India, UK, US, wherever, the value of a financial asset or financial liability is typically the present value of the expected cash flows emanating from that liability or asset. Okay. Now, employee benefits, etc., or we do what we do in actuarial work, it's no different. Our value, right? The fair value of the gratuity liability or leave liability is also, right? Unsurprisingly, that is also present value of future expected cash outflows from this benefit. So for gratuity, there is a gratuity benefit. I'm going to share some sample reports, during our presentation. We have time till 9:30, right? Sorry, just trying to just be doubly sure. We have time till 9:30. We have another 1 hour, right? In the presentation.
yes, yes,
Good.
yes.
Yeah, we'll cover that. So I'll be sharing some sample reports. I'll show you that, what we disclose in an actual report, and so that you can also read the report and understand. That's also equally important. While we're talking about inputs right now, in the next 15 minutes, we'll wrap this up. We'll then talk about the output and, how you can understand the report and what validations you can do. Anyways, so discount rate. It is, of course, super important because the value of this financial liability is nothing but the present value of the cash flows emanating from this liability. The actuary, using his projection software, the logic, obviously there is a multiple decrement. That's what we study. We basically use joint probabilities. Since I'm a CA, I can tell you that this is what we do. And at least in a CA final paper, we talked about this project finance and joint probability, path-based NPVs, scenario-based cash flows on the project, and taking those joint probabilities and then evaluating the NPV IRR of the project. That's what we do for most of our work, albeit in a more elaborate and an extensive manner. But that's the principle. And so in principle, we know it as CAs, right? We've done it. But it's just more elaborative. We look at what's the probability of all the different outcomes and the cash flow associated with that. And we derive expected cash outflows. In a life insurance context, we'll also evaluate expected cash inflows. But here, of course, in employee benefits, typically it's only expected cash outflows. And you discount those expected cash outflows, we'll get the provision. So what is the discount rate? How do you set it? Now, first thing is the source of the discount rate. In India, if you look at accounting standard AS 15 or Ind AS 19, it says it should be a deep and liquid government bond yield curve. Yeah, we need to select a government bond yield curve in India. In IFRS, if you look at IAS 19, which is applicable, which you do especially in Middle East and some parts of Europe and Southeast Asia, where I work for a few clients in these markets, they say you need to choose corporate bond yield curve. In case a deep and liquid corporate bond yield curve does not exist, you can choose a government bond yield curve. So that's on the discount rate. The guidance first is on the yield curve, corporate bond versus government bond. And in India, it is government bond. But under IFRS, you first need to choose corporate bond, and then if it's not available, then government bond. This is also similar to the US GAAP. So there are relevant standards under US GAAP also, obviously, for all this work that we do, which we also do work for certain clients under US GAAP reporting, especially if the holding company is in the US for consolidation purposes. Under US GAAP also, it is corporate bond first. Deep and liquid corporate bond exists, you can use that. That doesn't exist, then you can use a government bond. So that's the first criteria with regard to the guidance given by accounting standards on the yield curve. The second thing is, how do you select an appropriate duration for the yield to be used? So on 31st March 2024, I give you the yield curve. Then how do you select one weighted average yield, right, for use in the valuation? Because and over there also there are differing practices. I'm just telling based on my experience, the last 10 years I've been in practice. There are specific guidance notes for actuaries working abroad, which we have adopted, of course, when I've been doing the work in India, which simply says, which I found most commonsensical, which simply says whatever cash outflows are there, which is projected by the actuarial software or actuarial techniques, like I mentioned, each benefit you can project the cash outflow. Year 1, year 2, year 3, what's the cash outflow? That's what, we learn in our studies, etc., joint probability, this and that. And we can project what's the cash outflow. So the guidance note, which is called ISAP 3, just for people who are interested in International Standards of Actuarial Practice 3, ISAP 3 says the simplest way to sort of value the benefit is you have a swap yield curve, right? Year 1 discount rate, year 2 discount rate, year 3 discount rate. And you have cash flows also, year 1 cash flow, year 2 cash flow, year 3 cash flow. Simply discount year 1 cash flow with year 1 discount rate, year 2 cash flow with year 2 discount rate, year 3 cash flow with year 3 discount rate. You'll arrive at a liability. It's simply add it up, discounted value of those cash flows. And what you can do for representation purposes, you can goal seek what discount rate, a flat single unit discount rate needs to be used such that the resultant liability will be equal to what was derived using the curve. So, just to sort of break it down in steps. So I have, say, cash flows for 10 years, year 1 to year 10. I also have the discount rate applicable to each of those years, year 1 to year 10, given by the market yield curve, say government bond yield curve. So the value of that liability, let's say this is a gratuity valuation, and the value of that liability is simply year 1 cash flow discounted for first year discount rate plus year 2 cash flow discounted for 2 years using year 2 discount rate plus year 3 cash flow discounted for 3 years using year 3 discount rate, so on and so forth. Then I'll come to some number. When I do all of this, some number I'll get as the total value of the gratuity provision, which is the present value of the future cash flows. Then in my report, obviously, I don't want to give an entire yield curve. I just want to give one unit discount rate, one rate. How do I arrive at that? It's very simple. Simply, I will now, in the model, replace the discount rate curve with a single unit discount rate, one discount rate, instead of a curve, which, obviously varies with time. Year 1, year 2, year 3, the discount rate varied in the first step. In the second step, I will goal seek, I'll do a what if calculation in Excel or any other software such that that unit discount rate, single discount rate, which doesn't vary across duration, that discount rate, which I goal seek, will give me the same value of the provision that was derived using step 1 with a yield curve. So it's obviously, it'll be that yield that will come will be somewhere a weighted average. It'll lie somewhere between the yield curve, and normally yield curve in most markets are upward sloping. So automatically it will come somewhere in between, then you can read off the duration based on what you get. The reason I'm saying this is very simple and it's easy. We're a valuer association. I'm sure we're doing this day in, day out for different, liabilities that you're valuing in your work. We're very intuitive and very simple. So this is one very popular approach, mainly used abroad. In India, some actually use this approach, but most actuaries for Indian work, they use a more simpler approach. What they do is they calculate the, like I said, at the end of the day, this is a, there are a lot of judgments involved in the work we do, and there is some sort of leeway given the fact that this has also evolved a lot, and these guidance notes, etc., slowly emerging in India. Whatever guidance note I told you is an international one, which is applicable for work outside India, and we follow it whenever we do work outside India. But what Indian actuaries do, and we have sort of adopted, is a more simpler approach to determine discount rate, where we say, okay, look at the employees census, look at the average expected working lifetime of the employees. So, example, if an employee is 30 years and let's say retirement age is 60 years. So, ignoring the probability of attrition, etc., he will remain at work for the next 30 years. However, there is a 10% attrition rate. Let's say that is the assumption we use, 10% for future attrition. So normally it's obvious that, it's not certain that he's going to stay in the company for the next 30 years. There is a probability attached to it. So we take that probability into account to derive what we call for that employee the expected number of years he will be in the organization. So with a 10% attrition rate, obviously it will not be 30, so it will be lesser than 30. And effectively, it's a geometric progression only. It's like the AR squared that we say. if you just take a 10% attrition here, ignore mortality, it'll be a geometric progression only, where, it'll be, that is 1 minus, A divided by 1 minus R, a geometric progression, which is going towards, 0, which is a reducing progression, because attrition is, sort of reduces the population. So what we said, A divided by 1 minus R over here, if you use some of those mathematics involved, you can also cross verify what the actuary is coming out with. But ignoring the heavy duty mathematics behind it, the logic is what I wanted to impress upon you people. The logic is, we look at an employee's expected working lifetime in the company. In theory, an age 30 employee can work for another 30 years with a normal retirement age is 60. That's in theory. But since the assumption for retirement or resignation, apologies, in this example is 10% per annum for future, so there is only a 90% chance he will continue working in any given year, provided he's worked in the previous year. So with that mathematics into account, typically in this case, mortality, like I said, is very small. So your expected working lifetime will be around 8 to 9 years, or 8.5 years it'll be. I mean, that's just the maths involved. So for each employee, we
Could I
evaluate.
please interrupt?
Sorry?
Yeah, could I please interrupt? I have a very basic question.
Sure.
So, I mean, you were telling me from what I understand is there are 3 criteria that you need to evaluate, which is, the salary increase, attrition, and mortality rate, right? When in doing all of these,
And
valuations.
discount also. Mortality, we just pull it off a table. We don't do much evaluation. We have a standard actuarial table published by the institute. We use that table age-wise, the mortality rates we take. But yes, discount rate, attrition rate, and salary. 3 assumptions. Critical. Yeah.
Okay. Yeah. Thanks for correcting me. The only question that I wanted to ask was, do you do a sanity check of the data when you collect the data? See, you're relying on the data that is given.
Yeah, big time. We do lots of checks. Yeah. I'll talk about that as well. Thanks for asking that question. Thank you so much for asking the question. So let me talk about the critical checks we do. Thank you. So
the question that I had was, a practical question that I had was, assuming an employee actually leaves the organization, say on 31st March 24, and his name is already appearing in the data. So will you actually ensure that that data is excluded and all people who have left the organization or who have already tendered their resignation? So let us take about 2 or 3 scenarios. One case where the employee has left the organization, say on March 31st, 2024, and another one who is on the notice period, tendered the resignation on March 1st and going to get relieved either on April 30th or May 31st. So do you actually exclude the data of all these people who are on notice and people who have already left the organization, or will you simply just consider the data as such that is given by the by the company, and that is where their the names are appearing in the salary register as at 31st March 2024? That's the question that I have.
Thanks. Let me just take that in exactly 5 minutes. Thank you so much for the question, but that adds a lot of context to what I was anyways about to explain using this format. 2 minutes. Your good name, ma'am? Sorry, who raised the question? My name is
Kusum.
Yeah.
My name is Kusum.
Kusum, yeah. Hi. Thanks, Kusum. Thanks for the question. All right. So I was just concluding for discount rate. The internationally, there's a standard guidance, which I mentioned, simply the present value of future cash flows using the spot yield curve. That's it. And then you do a goal seek for a unit discount rate, which is very, very intuitive and simple, and put that in the report. In India, we look at the expected working lifetime of the entire group. For one employee, I just mentioned, there's an actual mathematics behind it. It's called the Curtate working lifetime. And it's effectively a geometric progression only. But anyway, so there is a maths, simply probability of surviving each year is taken into account. You survive attrition, you survive mortality, then only you can work that 1 year. So there is a weightage associated with each year of future service. It's not certain. It is probability weighted future service, in the company. I gave an example just now, the age 30, retiring at 60, while 30 years is theoretically possible, but we attach weightage for each year of future service, and it'll actually come to 8 or 9 years only for that employee. Similarly, we'll do for all employees, take a average across all employees. That duration we do a VLOOKUP on the discount rate curve of that particular valuation and use that discount rate. So that's all I wanted to say, limited point on the discount rate setting. And these are very detailed things, right? I mean, obviously, as you keep working and looking at reports, you'll also build your insight, but I'm just telling that's 3 important things. Now, jumping very quickly into the sanity check on the data. So, ma'am, Kusum, the simple answer to your question is, we have to exclude any employee who is on notice period on 31st March. We have to exclude him, okay? And we actually specifically ask in our data format, people who are notice period, now, we have this thing. Can you see this cell? I put it on green. So outstanding payment for employees on notice period. So we don't do actuarial valuation for employees on notice period for a very commonsensical reason. Somebody who's already on notice period, I cannot apply the probability of attrition on him. He's already attrited. It's like somebody who's already dead. You don't put the probability of death on them. Same way, this employee or group of employees on 31st March 24 are on notice period. They've already resigned. There is no probability of resignation applicable to them. You know their expected exit date. We don't need to project them, frankly. You know what is the expected settlement amount also. We directly take it from the organization. We give them guidance. Of course, it's up to the organization. Beyond a point, we cannot keep on checking. But we clearly tell them, do not include them in the census data. In the data current, for the current year. Or even if they're giving us previous data for comparison, even there we request them not to. Otherwise, it distorts some of the comparisons we make for the trend on salary and attrition I was mentioning, right? Even that's a sanity check on the assumptions. We look at the trend of salary and attrition with using past data within common employees, etc. So we ensure. So that's the first scenario you mentioned, Kusum. 31st March 2024, anybody on notice period should be excluded. Second thing, how do we know that somebody who's exited is not included? Yeah, that's definitely something we tell them, but we also have an exit list here. Okay. So we explicitly tell the client the date of exit is given here. So we tell them if you put an employer, don't put them in the census data, obviously. So we have also tried our best to tell, and we generally see clients understand this, that somebody who's left the organization in the intervaluation period, he cannot come in the census data. So they give it in the exit list. So definitely we also check if somebody is on the exit list and in the census data, we ask questions. In fact, we have a set of 30 questions. In fact, if I pull it up again, I'm just conscious of time. I want to show you the report, and I think there's so much to talk in this topic. Maybe we'll come back on a more detailed deep dive session later on specific areas. Like each topic can be spoken so long, but nevertheless, it's a very relevant question you asked, that we exclude employees who have been who have exited in the intervaluation period, because we are separately taking data from company of exited employees in the intervaluation period and also closing and opening. So we obviously, if it repeats, we ask the question saying, why is he there in the exit list and in the census data? Now, what is his status? Please tell us. And notice period, I'm saying you have to exclude them and simply give us the expected payout amount, which we'll add to the provision in our report. Third, ma'am, what is the third scenario you asked, Kusum?
No, these were the only two things.
Okay,
Either they
good,
have
good.
left the organization as at 31st March
31st
2024, or they are on that notice.
Notice.
Where
Fair enough.
we
fair
know
enough.
that the exit happened
Yeah.
in 1 or 2.
Yeah, I hope the answer was clear.
Absolutely. So I'm also understanding that, if it is for valuation purpose, it is excluded. Even, when the entire thing we are actually doing, we are talking about how we are going to go about this actuarial valuation, right? That is the
Correct,
topic that
correct.
we are talking
Correct.
about.
Correct.
So that means to say that it is the responsibility of the employer to share appropriate data with the
Always. We
valuer,
always do
correct?
disclaimers. With thousands of clients, it's impossible for us to do an audit of the data. We quite rely on the employer and the auditor to ensure the data is right. We obviously give a proper data format, proper instructional email. We even have conference calls before the data is shared saying, please take a look, wherever required, right? We don't do it for every client. And existing clients have sort of understood it across time. So there is a clear push from our side on data quality. But unfortunately, I as an actuary can't own the data input here. I can't. And I won't also. Even our our practice standards clearly states it's the ownership of the employer. He needs to ensure the data is appropriate, though we've given all the guidance and all the explanations involved. And we ask questions, right? Wherever we see an abnormality, quickly we ask. Like I told you, if an employee appears in the exit list and in the current bill, why is it there? We ask several questions, ma'am. For instance, if there's an employee appearing in the census list current year, but previous year, he was not appearing, and the date of joining is several years into the past. Ideally, it should appear in the previous census also. So we asked them, why is this guy popping up? Why is this happening? Alternatively, if there's an employee appearing in the
Omitted
last year
data.
list, sorry?
Yeah, data was omitted to be provided in the previous year itself. So that means, that also means to say that the number that you had projected in the previous year was incorrect to that extent, because
Naturally, right?
the
Obviously, that
liability
employee,
was
it's
not
highly dependent on data
provided.
quality. Of course, ma'am. So we ask, we do a mini audit of the data, but yeah, we ask several questions. Some clients respond in a, obviously they want to also improve. Some clients are, why so many questions are being asked. Our previous actually never asked so many questions. These are,
I
we
have
face a
come
lot of
across
practical
a
issues.
situation where, I have come across a situation where, the actuary is actually giving the option to the employer, telling that you want us to include, we will include. You want us to exclude, we will
No, I don't do that,
exclude.
ma'am. But
I mean, I don't,
they could see. I wouldn't know. I
yeah,
can't
no,
comment on other practitioners. I cannot comment on other practitioners, honestly. But I have never told this. I have told boss, It's a very simple thing. You exclude it because it. Like I gave you a simple example. Why would I project an employee already who's attrited? He's a notice period. He's attrited. Why will I apply probabilities on him and project him? The only exception to this
the
rule,
correct
ma'am.
approach is to exclude.
Yeah, naturally, of course. Yeah, it's
Correct
common
approach is to
sense.
exclude them.
Yeah, and I'm giving you logic. I'm not. That's the thing I'm trying to impress, that there's a logic to it. I am projecting each employee for attrition, deaths, and eventual retirement. That's what we're projecting through the actuarial calculation, the cash flows. Eventually we're projecting the cash flows for each employee, and then we add it up for the company level. And we discount those cash flows. That's what we get the provision, okay? That's the real work. The disclosures that emanate are basically a byproduct of the projection. All this current service cost, interest cost, this and that. But that's the logic, Kusum. You cannot include somebody who's already attrited. It's like including somebody who's already dead and putting probability of death on him, right? It's no different. You're including that a person is attrited, he's on notice period. So you just get the expected outstanding payments and you club it with your projected benefits. It's just one single place where all the employees are covered. I mean, ideally the company can do it themselves, but as a matter of good practice, we ask them and we say, please exclude them from census data. Tell us the expected settlement amount and we'll add it. We normally there's no choice. There's only one exception, Kusum. In a large organization, so we have an organization where they have 80,000 employees. To be honest, I'll have to be practical also. It's 80,000 employees and this is a staffing company. It is possible people are on notice period and they're not able to identify it because several reasons. These are working on client sites, this, that. There we say, look, what to do. It gets covered in the wash. I mean, even there we insist. We say, please try your best. But if there is a practical limitation, yeah, we are also happy. But otherwise, the guidance is very clear and it's commonsensical, right? But Kusum, have you come across any of these situations? Because your question is so pointed. Have you seen the situation like notice period, etc., where people have included
I had a
them?
practical situation. No, I have not yet included.
Good.
But practically, that is the communication that came to us was, you want us to include?
No, there's no want us.
us
No,
to,
ma'am. No, ma'am.
include, we will exclude.
It doesn't. Then,
So
ma'am, then
that
we're not
is
doing
the
our job. If you want, look, I don't want to ever tell a client that if you want, I'll do this. I'll tell this is what needs to be done. All right, you do it. It's your call, even for assumptions. But we will have to protect our professional interests. So we put some disclaimers in the report. Example, even on assumptions, I told you, we comment on reasonableness on salary and attrition. We comment on the reasonableness. Suppose you say my future salary assumption is 0% because last 2 years I gave 0 increment. Look, eventually it's your report, your organization, you are the owner of the enterprise, but I need to make a comment on the reasonableness of that. And I will make a comment saying, this doesn't look reasonable. This doesn't look reasonable at all. As per APS 27, we have some. So we always tell employees, and 99%, man, employers and auditors, they understand and they really align. And there are 1%, of course, rogue clients everywhere and rogue auditors also. I'm sorry for using that. I'm also CA. I love the fraternity and very proud of the fraternity, CA fraternity as well. But yes, there are some rogue players, rogue traders. They do whatever they want. So that's the only thing. But yeah, coming back to your question, ma'am, there's no choice. It's common sense. Exclude people on notice period. But I will also like to highlight one thing, ma'am. Materiality wise, it won't be a very big change from the number. I mean, I'm just trying to say, while commonsensically, why do you include somebody? However, even if it's included, let's say, I'm saying materiality wise, it won't be a big difference because that provision will get covered in the wash. Unless and until it's a very, very, very small organization with maximum number of people on notice period, right? Mostly the people on notice period will not even be 0.5% or 1%. Anyway, so that's that. So ma'am, just moving on very quickly, just conscious of time. So we also get details of the LIC statement or fund value statement of private insurers, like opening fund value, closing fund value, the contributions made during the period, the withdrawals made during the period, any charges deducted, because that is supposed to be covered in our report, which I'll show you shortly. Over there, it's not much actuarial brain. We just take it from the, insurance company. We take it from the client. They get the statement and we use that. So like I said, because I mean, there is also this whole thing on plan benefit, right? For gratuity, usually it's 15/26, vesting of 5 years and 20 lakh cap, but it could be different. So we ask that from the client in the data format itself. If people can see my data format, gratuity benefit, and for leave, we again ask attrition, the so-called accrual rate. It's either how to convert monthly salary to daily salary. Do we take denominator of 30 days, 26 days, 22 days, so on and so forth. Normally it's 30 days, but sometimes employees or employers also use 26 days. That's the accrual rate for leave. And we also ask certain information on the leave, which is basically the annual entitlement every year. How many leaves gets credited? How many leaves can be carried forward? How many leaves can be maximum? A lot of these limits and sublimits, obviously leave policies are complex. We take all of that in the valuation, right? So very broadly, the scheme benefit, the scheme design, we take from the employer, either an email or some approved document, and we validate it. Okay, so this is important. We do it as part of the due, especially the first year when we do the work. Second year onwards, it's only a change. We just check, is there a change or not? So these are some of the critical assumptions, okay, that we take. And obviously exit list also we take, like I told, we do a lot of mapping. We do a lot of checks, ma'am. We also do checks on abnormal salary increases between intervaluation period, abnormal attrition. Somebody's got 500% salary increment, even if it's one employee, we are saying, is it true? And we've seen reduction in salaries in intervaluation period. We do tremendous amount of data check. That's why we take the data current, data previous, and we need employee IDs, If they don't give it to us, a big problem. Then how do we compare? And we look at trends on attrition, trends on salary increments. Usually it's done using common employees. Like I said, each of these topics are quite detailed by themselves. But yeah, we do a lot of these things. We should talk about it at a separate, maybe session. And some of these metrics, how we evaluate, how do you even check the trend? It's not like normally how HR does. We do in a particular way. We look at common employees only. There's a logic for that. So we do all of that, ma'am. We do all these data checks, ask questions to clients, wait for responses. Literally, we pride ourselves of being a mini audit. We do a mini data audit only. We do lots of questions, and most clients, understand the value of it nowadays, and they also sort of respond and, help us make the process better. That's the end of the day. That's the only objective. We want to make the process better. So very quickly, if we had any questions on the data, at a high level, whatever we've discussed, any further questions? Kusum ma'am asked a very good question. And I hope, Kusum ma'am, I hope you got the response. Are you clear of the logic as to why we are excluding them?
Absolutely clear. Thank you so much for that.
No, more than welcome. That's our job. Any other questions, sir, before we can quickly go? And this conscious of time, we have around 40 minutes. I also want to take 10 minutes off for some final questions. So 30 minutes tops. I want to cover the report. I want to show you the report contents, etc. Can I proceed? I'll just then talk about the report.
Yes.
Yes, sir. Proceed.
Yeah. A few other things, of course, so many things are there. I'll do it the fastest I can. So like I said, there is this, we just spoke a lot about the data, attrition rate, long-term best. We spoke a lot, obviously, right? So that's fine. The one small thing I want to also tell you is the salary details you need to give it to us should be on 31st March. So many times we do valuation 6 months after financial year. I do valuation in September, October also sometimes for a March closure. But the salary details we need, is the March 31st salary. We don't need the latest salary, obviously. And we don't need payroll data. Some of the problems we have faced is sometimes client gives us payroll. Somebody's been on leave for 25 days in March. So he will give us 5 days salary of March. We don't need that. We need full month salary, because that's the benefit, right? So small things that we need to take care of. I mean, we've seen all this practically, a lot of variations. So because like I said, this is a garbage in, garbage out process, unfortunately. So we give guidance, we give training, we put data formats. But yeah, that's the best we can do. At the end, we want the auditors and the company to please, give us the right data. Otherwise, there's the meaning of this process. At the end of the day, it's so critical to get the right data. Anyway, so method, I don't want to talk too much about it. This is a very actuarial thing. There's something called the projected unit credit method, which is what is there for IND-AS and AS. There's a particular logic to it, but given the, time, and also it's probably not relevant for our forum as much. So it's more of maybe an actuarial forum is more relevant, but yes, very broadly it talks about averaging everything on a straight line method, which is there in every accounting standard, I have read at least as a CA. So everything is usually, you average it using a straight line method. So here also, we look at total service, what is the cost that will be paid out, and then we eventually average it using past service by total service at an employee level. And then that's the payout. And then we discount it, like I said. So we'll come to disclosures. I'll just try to open a report. It'll be faster that way. I'll just quickly open one sample report and then we'll talk through it. So how many people are familiar with actual reports? I think Kusum anyways just mentioned clearly that yeah, she's been dealing. That's great. In the team, anyone else who has seen a typical actuarial valuation report? How familiar is everybody here? I mean, majority of people have seen it or not seen it? An actuarial report.
No, sir.
Okay, good. Chalo, I'll try to make it as contextual.
Maybe one
So-
other request that I'll have, if time permits, is, how one can actually map the data as per the actuary's report to the data appearing in the financials. Because ideally, whatever the data that actuary gives should also be in some way or the other reported in the financial statements, right, by the auditor.
Definitely.
If you can just throw some light on
Sure.
how it can be mapped, it will be useful for the audience.
No, definitely. So, one second. No, definitely. So if you see this, so in this case, in this plan, can people see my screen? Is it visible?
Yes.
Is this?
Yes.
Yeah. So defined benefit obligation is 61 lakhs for 31st March 17. 31st March 16 was 61 lakh 59. It's a sample thing we've given. Fair value of plan is basically the LIC statement. This is different. What earlier talked about LIC doing actuarial valuation. Here it's a fund statement which any insurance company will give you: opening fund value, closing fund value, blah, 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 which we take. This is the opening and closing fund value. And this is a funded surplus or deficit. We see whether the fund is in surplus or in deficit. So typically in the accounts, in their books of accounts, you must be able to the provision for gratuity will be defined benefit obligation, ma'am. This defined benefit obligation, the ledger entry should be provision for gratuity. You should see it in the insurance company accounts. Fair value of plan assets, of course, is, I mean, I haven't gone to this level of detail in the insurance company accounts, but my presumption is this should be a separate account for the assets, because every time they're paying contributions, right? See, what tends to happen is sometimes people just create a trust account, especially if they have the trust. So the trust is the, like a debtor on the balance, whatever. I mean, they've given money to the trust, right? Effectively, the trust will pay money to the insurance company. But nevertheless, just ignoring the granular dynamics there, the logic is I'm a company, I keep track of the liability, which is my provision for gratuity, gross liability, and I also track the assets I have against that liability, either, in some form or fashion. And as per accounting standards, the disclosure in the balance sheet per se, ma'am, is disclosed net of assets. As per accounting standard, net. This is what is disclosed. The last line. Funded, liability or asset recognized in the balance sheet, ma'am. This is what is recognized. That's what you should see. Okay. But the main thing is the liability is what the actuary gives. The liability, provision for gratuity, gross liability. This should come from the actuary report, what we certify. Assets, of course, like I said, this gross assets comes from the LIC or the private insurance company fund statement, and the difference with the net one. And then, of course, you have these components called service cost, interest cost, expected return on plan assets, actual gains and loss, etc. So I'd like to spend a minute on each of these items. It's a little bit complex, but I'll just try and spend just one minute, right? As much as possible. Service cost is effectively the increase in liability over the intervaluation period due to additional year of service. That's what it is. People have worked typically one more year of service, right? From opening to closing, all the common employees. So that extra year of service leads to extra liability. That's the increase in the gratuity liability for that 1 year of service. So that's what this comprises of. When you do the valuation, I told you some byproducts arise. This is one of the byproducts, current service cost. This is relevant because you expect stability in service cost. Typically, as salaries keep increasing and increasing, service cost keeps increasing and increasing because the value of every additional year of service keeps increasing as the salaries keeps increasing. Okay, that is there. One classic case I can tell you is in gratuity, if somebody has hit the cap, I'm just telling you a small insight. If somebody has hit the cap of 20 lakhs, then current service cost for that employee will be 0. Why is that? Can anybody say? So 20 lakhs is the cap of the gratuity benefits. So beyond 20 lakhs, the government or the law typically does not require you to pay any gratuity. And the gratuity formula, as you know very well, is 15 by 26 into number of years of service into the gratuity salary. In this case, we'll assume it's basic salary. So basic salary into 15 by 26 into number of years of service. I am saying current service cost is the incremental liability for every additional accrual of service. Every year, the past service increases by 1 year. That increase of 1 year past service leads to additional accrual in the liability. And I am saying someone who has hit the 20 lakh cap last year, based on his service last year and salary last year, he's hit the 20 lakh cap last year itself. So for the intervaluation period, current service cost for that guy will be 0. Of course, this number is presented at a consolidated level, at a group level, but it's a summation of employee level dynamics. Why do you think the current service cost for such an employee will be 0? Anybody? Any guesses?
Is there a company policy that gratuity will not be paid beyond 20 lakhs as per the government?
Most companies have that
ceiling
policy,
limits?
ma'am. Most companies have that policy. 95% of companies have that policy. Yes. Because the government
If that is the case, then there is no requirement because the provisioning has already been done in the past. So there is,
You're right.
therefore,
There's no
there is
further accrual.
problem.
Yes, ma'am. There's no, I mean, provisioning will be there, but there's no additional accrual of benefits, which means that guy still will be paid 20 lakhs whenever he leaves. But incremental liability cannot get accrued because he's already accrued the maximum benefit he could accrue. It's 20 lakhs already, right? So that's the logic. Yeah, you've got the thought process right. Because there is a cap, his additional year of service doesn't lead to additional benefits. That's why there is no service cost for him. Anyway, so yeah, I'm just giving a small dynamic. I mean, obviously we check all these things when we do the work. So service cost is additionally that essentially each year of service additional cost. Interest cost, which is the second thing. Interest cost is extremely logical. It says people are closer to retirement by 1 year. Everybody is closer to retirement by 1 year. So interest cost is nothing but opening provision into the opening discount rate, adjusted for any payments, because all the people in the opening, it's like an unwind of the liability. So opening discount rate, you discounted the opening provision, you also opening discount rate. Now interest cost is saying everybody is closer to retirement by 1 year in the opening census. So take the opening provision into the discount rate, it's opening discount rate. That's like an unwind effectively. But we also subtract any people, there are a lot of people who leave during the period. People who leave and you pay them during the period. That is also sort of adjusted. Any payouts? Ideally, what we do, and you should do, is each and every person, whenever they leave during the intervaluation period, you take a negative interest for those people based on the date of leaving. But for simplicity, we always, 99.9% of actuaries assume, including me, we assume that the exits occur at the middle of the period for simplicity, unless and until it's a, say, employee census of 1 lakh employees or 10 lakh employees and tremendous amount of attrition is happening. For most normal cases, 500, 7,000 employees, 2,000 employees, this is pretty good approximation that all employees on average leave at the middle of the year. So we take a half year negative interest credit for the payouts made during the year. So that's the interest cost. It's simple. And the accounting standard is also very simple. It says it's the unwind of the liability. It's the fact that liabilities are now closer to maturity. Okay. So that's what the interest cost is. Then you have something, obviously, something called expected return on plan assets and actual return on plan. Expected return on plan assets is more of an AS15 item. But nevertheless, it says, what do you expect to earn on the assets that you have? Adjusted for any payouts. What is the expected interest? And actual interest that you earn will get sort of indirectly covered in the actual gain and loss. This metric called the actual gain and loss consists of 3 components in an AS15 report or in Ind AS 19 for that matter, but it's the change due to assumptions, any variation in actual experience versus expected experience at the beginning of the period, and also any variation between actual experience and expected experience on the assets side. 3 things that get covered in the actual gain and loss. And we normally focus on this actuarial loss and gain metric because it also signifies how good your opening assumptions have been. So if I just quickly go, this 11,03,000, 3 component, like I said, it is the actual gain and loss due to assumption change, actual gain and loss due to experience change, and actual gain and loss on the assets. So here, this is on the liability. I'm just telling everybody that opening liability is this 6.15 million. Obviously, service cost increases the liability, interest cost also increases the liability. Now, in this case, there is no benefits that are paid. This is just a, it's a sample that I've taken, but in reality, most cases, there will be a benefit paid. There will be some gratuity benefits being paid. In this example that I created, I took some obviously random client and I sanitized the names, etc. It looks like the benefit payment is not there, but that's okay. That will be a reduction in the liability. But people can see there are two metrics we have: actual gain and loss due to change in assumptions, actual gain and loss due to experience, and the closing provision. So the actuary, that is me, I evaluate the closing provision with all the techniques we discussed. Take the data, set the assumptions, run the model, discount the projected cash flows, and get the value. Opening also, somebody would have done, either me or some other actuary. Service cost and interest cost are byproducts. Assumption change, this also we quantify. Change in loss, change in, whatever, impact of change in assumption, we quantify. We run the closing provision using opening assumptions and the closing provision using closing assumptions. The difference is the assumption change. What I want to tell everybody is this: actual gain and loss due to experience is always a balancing figure. It's a balancing figure. It is what has remained out. So it's not exact, but we do try and interpret, okay, why it has happened. Of course, we know the reasons why it happens in principle, but for people's knowledge here, all this is a balancing figure. Actual gain and loss due to experience is typically differences between what we experience in the current financial year vis-a-vis what was expected to happen at the opening period. So classic cases, we expected a salary increment of 10%, but actual salary increment in the intervaluation period is only 5%. So you will get an actuarial gain there because your liability is not increasing as fast as you want. Similarly, the attrition that you expected was 25%. But actual attrition was only 10%. Again, it is a little tricky to talk about directionally, right? Attrition, whether higher, lower attrition leads to higher, lower liability, because there are several dynamics there, which I will definitely try and touch briefly. But yes, this is actual versus actual. I'm just trying to charge my laptop. 1 second, guys, just 1 second. Yeah, so this actuarial gain and loss due to experience is a very important metric. And just want to spend 2 minutes on this because it tells us how good our opening estimate has been. When I made an estimate of salary assumption and attrition assumption, and then, I ran the, obviously 1 year has elapsed, that tells me it reflects how good my opening assumption setting was process. So the thumb rule, it's a thumb rule, okay? That normally 10% to 15% is fine. So if this number, and on absolute basis, if this figure, actual gain and loss on experience divided by the opening provision is around 10 to 15%, it's okay. If it is beyond 10 to 15%, right, range, on an absolute basis, it's negative, positive, doesn't matter. You could undershoot or overshoot, but 10 to 15% is reasonable because no one is God. You can't get it right exactly. It can't be zero. But consistently year on year, if you're seeing very, very, very high ratios, which means you got to make some change in the closing assumption so that next year you don't face this. So that's the small thing the limited point I wanted to make. We normally check this to see trend cut. Are we consistently overshooting the range? If we have 30%, 40% off. In this case, it's quite off. If you look at this client, this particular case, it's quite off. 15 lakhs. So which means the opening assumption setting was not accurate, but that's okay. I mean, yeah, these things happen, but we need to keep modifying it, keep, working into the thing. That's the logic. So that's on the liability side. On the asset side also, we have similar, right? These are all standard tables. All these tables are there in any actuarial valuation report. The fair value of plan assets, and this is prescribed by our institute. Anyways, we have this whole thing on opening assets, the closing assets. This is what I said. There's an expected return on the plan assets. What you expect to earn, 5,29,000 using some expected return. But there is also an actuarial loss in this case on the plan asset, which means the actual return was only around 4 lakhs something. I expected 5,29,000 in the year, but I earned only some 4 lakhs something. So 1,35,000 is an actuarial loss, as it's called, which is clubbed along with the liability side and presented in the P&L. So actual return on plan assets, there is a separate schedule in AS15, which we are supposed to produce, which is expected return, 5,29,000, actuarial loss, 1,35,000, actual return, 3,90,000. In fact, you open any fund statement, LIC fund statement or HDFC or ICICI, Kotak, it'll tell you this actual return. It'll actually tell you this 3,93,000 only. This is what you will eventually end up knowing. But they actually makes an assumption for the expected return. And this actuarial gain and loss on the asset side is, of course, a balancing figure. It's a balancing figure because my opening assets are known. my closing assets are known, my contributions to the plan are known, my withdrawals from the plan are known. Obviously, expected return is an actual assumption. Again, how much I expect to earn, and based on the closing fund value and all of the items, this becomes a balancing figure. Okay. And then there is a reconciliation we do on the balance sheet amounts. So someone asked about reconciling, but this is very important thing I want to say. Whether you understand other things or not, at least we must understand how to map things to the balance sheet. So in the balance sheet, we look at opening net liability, closing net liability. Net liability, as you know very well, is nothing but liability minus asset. Okay. So there is opening net liability, closing net liability. Then any benefit payments made by the sponsor, is reduced. Any contributions made by the sponsor is reduced. And the balancing figure is the employer expense for the period. It's a simple logic. Just for a minute, if I ask the members in the call, right, to just step back and think about T form of accounting, right? Any liability, ignore the assets, ignore the funding. Just think about the liability. You have a provision brought forward from last year, which is a credit balance. It's a provision. It's brought forward from last year, credit balance. There is a provision carried forward in the current financial year to the next year, which is again, two balance carried forward. By balance brought forward, two balance carried forward, right? Because both these numbers are given by the actuary. Okay, there's no, company doesn't have to be valid, we give it. Then any payments made, you debit the provision and credit bank. So you're obviously making a payment. Naturally, in the T form of accounting, if you visualize, the balancing figure is a P&L, debit P&L, credit provision. That's the adjustment. So you have the closing provision plus the payments less the opening provision, which will be the P&L debit. And we do these control checks, by the way, before we release the report. And that control check is reflected in Schedule A6 of my report. In some other actually will be some other schedule, but this is supposed to be given as per our actuarial practice standards. So automatically we'll see opening provision, closing provision, payments, contributions, and the balancing P&L expense. The only slight difference is once there is a contribution also in the play, that also impacts the P&L expense. So, I mean, this is all very intuitive. There's nothing, there's no rocket science here. After all, I'm making a contribution to the fund just to reduce my liability. I mean, all I'm doing is funding the liability so that liquidity and security is protected. And any returns I make on that asset which I've invested, any returns I make will go on to reduce my employer cost. Obviously, as you know very well, 5,29,000 is expected return, 1,35,000 is the actuarial loss, which means my actual return, if I add up both, is about 3 lakh, whatever we showed. 3,93,000. This 3,93,000, ma'am, flows into P&L indirectly. How it flows indirectly is, on the one hand, you have in the P&L expected return on plan assets, 5,29,000. But that actuarial loss of 1,35,000 is also within this overall item called actuarial loss and gains. It's within this 1,10,000. So 11,03,000, sorry. So automatically 5,29,000, which is a negative cost, is adjusted with that 1,35,000, which is a loss. So effectively negative cost of 3,93,000 flows in the P&L on the asset side. On the liability side, of course, we've discussed a lot. And the total employer expense comes. So the limited point I wanted to make is, whatever numbers we give, there is a schedule also we give that reconciles the balance sheet numbers to our numbers. I mean, it's actually there in the schedule. So you got to ensure that your balance sheet reflects this. Somebody, I think, someone did ask, just tying up these numbers with the balance sheet and the report. So I would suggest that whenever you look at a report, try and tie this number. Take the actuary report, search for this balance sheet reconciliation schedule. There's a schedule that actually reconciles the balance sheet's metrics and see if it matches with your balance sheet. Okay. And any questions on this, happy to take, specifically on this recon.
I have one doubt.
Yeah. Yes, sir.
For this, when you're doing this managerial, this profits calculation for CSR purpose and also for MD remuneration under section 198 of the Companies Act.
Okay.
There is a one requirement. Any notional gain or notional loss on account of a fair value recognition, that should be, we should not consider as a part of the pay and profit and loss account.
Okay.
So it means that when you're doing this calculation, it can be some notional gain or notional loss may come when you do the valuation. So how to identify where your then we have, as you know, we have India's companies and also non-India's companies.
Correct.
In
Correct.
both the case, all these days it is not people who are not very concerned. Now this 198 CSR profit we have to calculate based on the 198, where we need to do these adjustments. So one of the adjustment is this adjustment, notional gain or loss on account of a measurement of assets and liabilities.
Oh God.
So any idea on
Very
this?
I'm sorry, I've not come across this question per se. I mean, thanks for this question. It's a learning opportunity for me. But I'll just give you a top of mind answer on that. You're telling it's applicable only to key managerial persons, right? CEO,
No,
MD.
No, this is applicable to the now it is applicable for public companies where they're paying manager remuneration to the MD remuneration. Second thing is for all companies, whether public or private, for CSR calculation, whatever you calculate 2% of the profits, we have to calculate as per the 198. In that they given, you take a profits as per P&L account. There you have the adjustments. One of the adjustment is
Notional, any notional. Oh God.
so if the notional loss is there, it is not a profit. If the notional gain is there, accordingly we need to adjust.
I got it. See, so let me answer that in a commonsensical way. Thanks for that question. First of all, when we looking at the gratuity report, there is assets and liabilities, right? Two things. So assets, there's nothing notional, by the way, in the assets. Nothing. I'll tell you why. Everything is, that money is like there in the insurance policy. You can actually withdraw this money. Opening fund value, closing fund. This actually, if you look at the fund value statement of LIC, in this example, it was LIC was the insurance provider. They have a fund statement given to the employer. 67,56,000 is actually there to the credit of the employer in LIC records. They can actually withdraw this money. Okay, there's nothing notional about this. So on the assets side, you can clearly, safely conclude, in my prima facie opinion, you can clearly, safely conclude there's nothing notional happening, right? It's a fair value given by an external party, and that money is there. You can actually withdraw it. Okay, and that'll be, so that much I'm clear. I mean, whatever you told me, there's nothing notional on the asset side happening here. Now let's talk about the liability side, which is more interesting. Unfortunately, the liability side, everything is given by the actuary. Okay. Okay. Now, will you call the liability estimation we make? Like, so you give me, you're the employer, you give me data, we set assumption, we create a liability. Will you call this notional or actual? I'm asking you. Seriously, I don't know. We are trying to find an answer together. No, because because whatever P&L expense going, interest cost, service cost, because these are the components of the P&L, by the way, that the actuary gives, which is interest cost, service cost, actuarial loss, right? Okay. Service cost, everything that way only I give, like, through my modeling, whatever. But it's for the future. I will argue it's not notional. I would argue it's going to happen in the future. The timing is uncertain. The amount is uncertain, but it's going to happen. Timing is uncertain. We don't know when the guy will resign or die. Amount is uncertain. We don't know whether the assumption we made for salary escalation is exact.
Can I?
Yeah.
See, as you said, assets there's no notional. Where we come across, we get doubt is when you give the gratuity expenditure, you'll give the two items. One is a expenditure which we have to give to the P&L account. Second thing is gain or loss on account of measurement of assets and liabilities. That gain or loss will go and sit in OCI in my P&L account in case of Ind AS.
Correct. Well said. I had the Ind AS report also, but I'm just running. Correct.
So when it's sitting in days, then we need to see is it in a notional or real. So, but since what is notional? Whatever making expenditure or income, which is there's no liability as on the date crystallized, it is on an ad hoc basis. What we calculate gratuity actually, this is notional only. Because you're expecting that tomorrow it may come.
Oh God. See, look, interesting perspective, sir. I really want to reflect on this. Prima facie, I probably have to tend to agree with you because you're saying it's an estimation, sir. I don't know whether they call it notional or not. It's an estimation because the timing is uncertain, amount is uncertain, because the exact amount, we don't know what we're going to pay because we don't know the exact salary when he's going to leave. And timing, we don't know when he's going to leave. But it definitely is an estimation. Does estimation make notional? Does all estimations make the item like a leasehold? Suppose I do leasehold valuation. I'm just flipping the question.
It is a notional. I'll tell you another example. Assume that I have a payable of $1 lakh to the creditors.
Yes.
When I book the transaction, it is just 80 rupees is the currency. Yes. So 1 lakh into 80 lakhs is my liability.
Right.
And then 31st March, rupees depreciated. Assume that forex US dollar is 85. So what we'll do is, since if I close the books as on the date, if I settle the liability, I have to pay 85 rupees. 5 rupees I'll book as an expenditure, credit to the liability. So that is notional, because as on that we are only thinking that it will be closed, but as on the real closing, that is a different liability. Since this is a notional, this will be adjusted.
Right.
Now I think on the similar way, when it comes to gratuity leave encashment, what you're doing is based on timing as on the date, but actual liability is something else. That comes as a notional. So it means it's not
Interesting.
certain.
Okay. No, no, look, I really have to reflect. It's an interesting question for me. I'll work back on this. Thank you so much. I'll have to think back on this. I've never been posed this question per se. Okay. Obviously, we do this as part of the valuation, accounting valuation, so many auditors. But this is an interesting thing. Let me reflect on this. But the only point is, if you say it's notional, then all the OCI there's an OCI element for this report, obviously. I mean,
Yes,
I can
correct.
for people's benefit here who are not familiar with it, I just open just for their benefit, sir. So this is an Ind AS 19 report. It's the same report, but under Ind AS 19. Okay. So this is what happens. Under Ind AS 19, there's something goes to P&L, something goes to OCI.
OCI.
So here it's there. Remeasurement, of plan, past service cost. You can see current service cost, interest on DBO, interest on plan assets, so on and so forth. This is really the same thing that so this OCI remeasurements due to change in financial assumption, remeasurements due to change in demographic assumptions, remeasurements due to plan experience. So these three items. You are saying all this is notional.
Yeah.
Maybe.
So what we can do, we can continue. I'll connect with you later, because.
Oh, yes, sir, yes, sir, yes, sir, definitely. I'm just conscious of time. So there's a couple of things I want to cover, guys. We have 10 minutes, very quickly. Then we take some questions. If we can extend by 10 minutes, nothing like it. So quickly. Okay. So now, how do I check? So I've told you the basics of an actuarial report. But, how do I check, whether my actuarial value, I'm just going to open another file. See, you can't obviously challenge an actuary quickly because you're not an actuary. Naturally, there's so many things, but you can do some sense check, ratio checks. That's the one thing I want to leave you with. One simple ratio check, which will give you some broad sense whether the numbers are moving in the right direction. It is only to improve controls. In my view, we're all stakeholders in improving the quality of the work. So obviously, more than happy to sort of add my 2 cents worth. Just a second. Just 1 second. I'm just opening a file, which is talking about a check that we conduct internally, but I'm also sharing it with you guys so that in the future it's easy. So there is an item called discontinuance value. Before I open the file, I'm just trying to talk on this. Discontinuance value is supposed to be disclosed in our actual report. Discontinuance value is nothing but the amount that will be needed to be paid on the balance sheet date because company shutdown value. If the company shuts down, what will be paid to the, because it's winding up operations or so on. It's also called wind up basis. So discontinuous value basically says I'm going to settle all my employees based on the fact that I'm going to shut down my operations today. So this is supposed to be disclosed in the actual report. Okay. So I've just given a small example here and I will correlate with the actual report. This discontinuance value. Can everybody see my screen? Sorry. Is my screen visible?
Yes.
Great. So this is a very, very small sense check. And obviously, please, tomorrow, it's only to help you improve. And please sit down with it actually. Obviously, just because this control check fails, it doesn't mean there's something wrong in the actual work. Trust me, there are 1,000 other nuances, but this is a good control check so that you know that the numbers are moving in the right direction. You also enhance the process, in my view, right? If someone in the accounts team or the audit team can also check my numbers independently, broadly, because in 1,000 cases, it's possible. We're all human, right? We could miss something. So it adds a layer of control, like a third line of defense or fourth line of defense. That's the perspective, right? That's the perspective of sharing this. And like I said, it is a hard discipline. There's so many things that go through. So, you need to understand why the trend is failing if it fails. Okay. So I'll open my report, typical actual report. So just a minute. So when you look at the, report, there is this, I told you, discontinuance value that will be emerging here. So you'll have to go to this item called discontinuance value. It'll be there in the data section. Any actual report should give you this. Can you see? Can people see this item called discontinuance value here? There is an item I've marked in yellow. Yeah. 1 second. Can people see this? I'm sure. Yeah. So,
Yes.
yeah. So this discontinuance value, what this represents is if the company shuts down on the balance sheet date, what will be the amount to be paid to employees? In this case, even you can calculate this on the balance sheet date, salary into 15/26 into past service on the balance sheet date. Add it up. That's what it is. Okay. So this is there in the balance sheet. That's the point. Apologies, actual report. So you can source this number, discontinuance value, from the actual report, opening and closing. You can also source the provision, obviously, gross provision, gross liability, which is what we value from the actual report. What is the gross liability, right? Opening and closing. These two numbers you can source from the report. What's the defined benefit obligation, present value obligation, and what is the discontinuance liability, both opening and closing. You put it in an Excel like this. Okay. Discontinuance value and the provision. Then for the opening, this is FY23 opening, FY24 closing. I've just given a random example for people to understand. So then you take a ratio of the provision divided by discontinuance value. Okay. The provision is what is disclosed in the actual report for opening period. And the discontinuance value is also for the same opening period. You take a ratio. You expect very close consistency between this ratio, provision by discontinuance value, between opening and closing periods, subject to adjustment for any assumption changes. I repeat that. You look at the provision, the closing provision by closing provision by closing discontinuance value, opening provision by opening discontinuance value. The ratio should be very consistent. In this case, it's 70. But the only thing is, when you took the closing provision by closing discontinuance value, any changes in assumptions, which is also disclosed in an actual report. Like in this case, if I want to know what's my change in assumption impact, I go to, and these are schedules, okay, actual report schedules, which is a schedule for reconciling liability. You will find in this case, actuarial gain and loss due to change in assumption of the liability. See how much it is. It's a gain, 51,35,000, which means my liability is lower by 51,35,000 because of an assumption change. Whatever assumption change, salary could have gone down, discount could have gone up. So the assumption change has reduced my closing liability compared to opening liability. What I need to do in this case is add this back to the closing liability before I put my ratio check. The logic is simple. I have to compare apple with apple. I need to compare based on last year assumptions. I had this ratio 70%. In the current year, if I reverse the assumption impact, which means I get the current year valuation using last year assumption. That's what it means. And obviously, see, we have all this in our models. You as external people who just get a report, there's nothing else you can do but take these numbers from the report. You have the closing provision, which is there in the actual report. You have the impact of assumption changes, which is there in the actual report. The assumption change impact can be either positive or negative. Negative means it has reduced the liability. Positive means it has increased the liability. Obviously, whatever, you need to sort of figure that out and then add it or subtract it commonsensically. If there was a gain due to assumption changes, whether liability reduced due to assumption changes, you please increase back the provision by the same amount so that you bring it to the opening assumption level. If there has been a loss due to assumption changes, which means increase in provision due to assumption changes, you reduce that impact in the closing provision so that you bring it to the opening assumption set. So then once you adjust that provision on last year basis, which is the closing provision using opening assumptions, that's important. Opening provision anyways is on opening assumption, opening discontinued value you have, but closing provision, you need to bring it on the opening assumption basis, and the numbers are there in any actual report. Take the closing provision, take the impact of assumption changes, adjust it, and then calculate this ratio. In this case, it's a 70% consistency. So we check this, okay? Before we release a report, my team checks all of this. But I would also appreciate if you guys also, when you're doing your work, when you're checking a report, yes, there are 1,000 things to check. But this is an output check. Input check, of course, like I said, whether salary attrition is appropriate, is it in line with past history? Data, I think Kusum was asking about data, whether notice period, small things. There are so many things to check. But at a high level on output, this is a very sensible check. You should see consistency in trend. And I repeat one thing. There are cases where this may not be consistent, even after doing this. Please don't conclude there's some wrong thing happening. Ask the actuary. He will have some answer. There are many things in a small group with massive attrition or with massive salary jumps or some benefit caps hitting. A lot of things are there. Some unique cases are always there. So understand it. But more often than not, you must see very, very good consistency in this ratio. Okay, I just wanted to cover this small point. Any doubts or questions here?
As it is 9:30, you can take, you can open the Q&A session and we can conclude in 5 minutes.
Yeah. Sorry, guys. I know so much to talk. So I think I'm also probably done. Okay. So another thing I wanted to talk about, just 1 minute if we have, ma'am, just 1 minute. Because also I'm trying to put some insight into the way we do the work. I mean, checking the work. So obviously I told you we project and discount. Okay. So obviously what tends to happen is there is a sensitivity table given in every actual report. Have people seen this? I don't know. Sensitivity to assumptions. You'll see something like this. Opening assumption based on the base assumptions. And what is the impact of a 1% change in discount? What is the impact of 1% change in salary? What is the impact of some change in attrition? This gives you a sense of the impact of change in assumption to change in provision. That's the last thing I wanted to say. So this is also there in the actual report. It gives you something. Of course, assumptions are also there. The basis of assumptions are sometimes described. The source of the discount rate is described. Any special adjustments in the data are described, blah, blah, blah. But this is also there. Yeah, I'm done really. I'd love to open the floor for question answers. And I hope it added some worth. I mean, it's a complex topic. Sorry, there's so much to talk, but nevertheless, yeah, we did the best we could.
So is there any specific thing to what is the specific method to calculate attrition rate? Simple.
Yeah, there is. Yeah, there is. What we do is we look at common employees. So we calculate persistency rate, which is what I was telling. So HR does it in a way, they take new joinee attrition also into account. We don't bother about new joinee attrition, where people who join and leave in the intervaluation period are not relevant for us. Because we're doing a projection of the census on March 31st, 24 into the future. We are not worried about new people joining and leaving. That doesn't matter for the projection. So all we care about is common employees between opening balance sheet date and closing balance sheet date. In this case, March 23 and March 24, common employees. So if you take common employees, you'll get what we call persistency rate. So if there are 1,000 employees at the beginning, out of 1,000, let's say only 900 have persisted in the end. So the persistency rate is 90. So the attrition is 10%. That's how we do it broadly. I mean, obviously you can calculate this attrition rate varying with age, varying with past service and stuff, but the principle doesn't change. We look at common employees and arrive at persistency rate. 1 minus persistency rate is attrition rate.
And you do not take into account the employees who are under notice period, right? Neither in the opening, neither in the closing, right?
The employees in the notice period will come as, they will be excluded in the, yeah, obviously. Yeah, exactly. They're excluded. It's logical also. You should exclude them. To me, an employee, let's say there was an employee in the opening, and in the closing, he is there, but he's on notice. He's already attrited. He is already attrited. He must be part of my attrition count, no? Manlo, 1,000 employees are there in the opening, and 20 employees out of the 1,000 are on notice. They must contribute to my attrition calculation. So that those 20 should not be included in my closing 900. They should not be. Otherwise, my attrition experience assessment is wrong. They have attrited, yeah. They've not left the company, but they've attrited. So you should exclude notice period employees, both in opening and closing. And the other small thing, very good point, because you asked again, like I said, the more interaction, the more sharing I can also do, obviously, because when you ask questions, it's really helpful for us and the audience. You need to ensure you don't consider retirements as attrition. Okay, very important point. In a mature organization, see, young organizations never a problem because we hardly find retirements. Most Indian organizations are young, okay? Average age 30, 35 is not a problem. But in very, very old PSU, sometimes we've seen there are significant retirements. Retirement is not attrition, okay? Retirement, that's a planned event. So I just gave you an example, right? Common employees. So I remember I just told you that 1,000 employees at the beginning, 900 employees in the closing, persistency is 90%. So attrition is 10%. But unfortunately, there is star conditions applied. Fine print is, in that 10%, there are people who retired. If there are people who retired, I have to remove them. That cannot be attrition. So in 100 employees had attrited. No, in my example, 1,000 and 900 mean 100 have attrited. Let's say 20 have retired. So my actual attrition will not be 10%. It will be 9.8%. Those 20 retirements, retirement is not an attrition event. See, again, like I said, every topic here, it's There's a lot of nuances. Obviously, that's why actuarial work is also complex, right? Otherwise, everybody can just do it on a spreadsheet. There is some nuances here, but it's a very, very good question you asked. Thanks for that question.
Thank you, sir.
So retirement
Leela?
excluded when you do the experience analysis. Yeah.
We have come to the end of this session. Mr. Naveen, as a token of gratitude, a memento will be forwarded to you. Our
Wow.
admin will take care of this.
Thank you so much.
On behalf
Thank you
of
so much.
BVA, I request Mr. Munish to extend a heartfelt vote of thanks.
Yeah, many thanks, Shilpa, for this opportunity. And my heartfelt gratitude and thanks to Naveen, sir. So it's a wonderful session, very new for us because, actually it's been one of the toughest exam I can recall, when we were students and, those people who give, actually we consider them as more elite than, the chartered accountants and company secretaries. So so very nice that you are doing practice in this domain, and most of the business, a lot of few friends are actually, so most of the business you get from insurance companies, right? And
That's true.
and insurance is always a booming sector in India.
That's right.
Insurance penetration is at very low level in India, and it's growing. More and more products coming up. So obviously the actuaries has a great wings to fly, and and this SME, more than 10 employees. So you have explained it very well that it is applicable on every enterprises, even SME who has employees more than 10. So we need to sanitize our clients because 10 is a very small number. And a lot of statutory reports, you depict number of employees, permanent and contractual. So we need to sanitize our clients that actuarial valuation is a legal requirement. So we must get it done, and it does not cost much also, as I can see also. So that is not a cost burden for SME, which I personally feel, because few startups are coming to us also for getting actuarial valuation. We also ask them first, does the Ind AS apply and why you getting it? So they say the investor is saying. So I said, okay, even Ind AS does not apply, accounting standards applies. And then accounting standard AS15 also you need to get it done. Especially for gratuity, even leave in most of the cases does not carry forward. But for gratuity, it becomes mandatory. So thanks to Naveen sir, you told us about this thing, and special thanks for bringing comparability and bringing out new things in the new social code, and it will increase the cash flow requirement because it will be fund based, and then it will be 50% of the gross pay. So we need to sanitize our client, because third time also we have the Modi government, so they have labor reforms on the table. So more and more states will soon ratify this. So we need to bring this on the table and can bring one product to the client. And you, sir, answered all the questions very well. Kusum and others asked very relevant questions, and you answered it very well. So special thanks to you for that. And I hope you keep connected to BVA and give us all this knowledgeable session again and again. And that's it, sir. Nice. Thanks a lot.
Oh, yeah, thanks. I mean, it's a pleasure. It's mine, guys. Everybody, Munish and company, it's a real pleasure. I'm very passionate about coaching as a person. So I really value this opportunity. Thank you. Early morning is a new thing for me, by the way. I'm a late night, even when I used to study, I'm a late nighter. Okay. I don't wake up early, but anyways, it was very
Since all
entertaining.
the professionals are either CACS or CW, and we'll have these CEP sessions throughout Saturday, no? So we
Wow.
thought this is an ideal time which will never
No,
clash with
perfect,
anything
ma'am.
else.
No, I'm not complaining at all. I love it. I'm very passionate about coaching. In fact, if we could make this a 10-hour session also, I would have gone. So there's so much to share. Obviously, you have to contextualize it. And I tried to cover some basic things where you can also use it in your work. I mean, some gyan you get, you forget, but somewhere you have some tool. I'll send across a presentation also at Excel. So you can also try something. You must also engage, right? In the work, you might be going on an actual report in your work. Then you'll also know, okay, something I remember in that session. Can I check it? And if the trend applies, you will absorb it. So my idea is to, maybe amongst fellow professionals, make the process make the black box a gray box. Obviously, it cannot become a white box. It is an actuarial black box, but at least make it a gray box. Thoda bahut, little bit, so that you can understand, engage. And it makes you also more aware of the nuances, right? I mean, and as a professional, your clients rely on you, right? You have the trust with the client. It improves your trust coefficient with your clients. So say, okay, you can also add value by verifying this for me, and you're able to give your clients the right advice. At the end, that's what it is, ma'am. So, very happy to stay engaged. Very happy to ask any further questions. Please share my coordinates with everybody in the group, ma'am, my email ID and my thing. More than happy to get in touch with anybody anytime for further inputs. We should have this session more regularly, maybe once a quarter or once in 6 months, so that we can keep reminding, right? Reiteration is important. Thank you so much, Shilpa ma'am, and everybody for this session. Thank you so much. Bye. We'll be in touch. Thank you. Bye.
Thank you everyone for participating. Have a good weekend.
Thanks. Thank you.
Neela, you can stop the recording.